what does it cost banks to borrow money from the federal government, right, for their daily operations? And
right.
So I think everybody can agree that banking has gotten tighter as the federal fund rates ran up, right? Now, that was a focus of a couple things. Number one, if banks are paying more money for their cost of funds, right, they're going to charge more money for their products and services. That's just a natural cause and effect of the economy. And that's natural, right? So that made it harder for folks, let's say, to buy a home, right? We've seen a major slowdown in home buying in most markets because interest rates took off. But with all that is the backdrop of how COVID impacted the market, where we ended up with this massively inverted yield curve where, right, the 30-year treasury is supposed to be higher than the 10-year treasury, which is supposed to be higher than the 5-year, which is supposed to be higher than the 30-day. That is the natural course of economics that our entire economy is based on. And when that flips upside down, the federal fund rate kind of becomes the 800-pound gorilla in the room, for lack of a better statement, because everything is inverted, right? To borrow money for a day is theoretically cheaper than to sign on to borrow for 30 years. That doesn't align with business practices.
That's right.
And so we are now entering a period where the federal funds rate is not only coming down, but the inversion of the treasury yields is actually balancing itself back out, where longer term treasuries are again more expensive than shorter term. And so we are essentially getting back to what I would say maybe is a more normalized market condition. And to think back to when that last occurred, we're going pre-COVID, before we were in that period of a seemingly reasonable forecast for federal funds and longer term treasury yield options.
Oh man, I couldn't have put that any better. If you really just want to understand how this whole system works, go back about a minute and slow that down and just listen to that, because it took me a whole economics textbook to read and understand exactly what Rob just said in about a minute or in a minute and a half. You have to understand that we have not been in a normalized interest rate or yield curve situation for quite some time. And we're going to talk about that. I have some graphs to actually showcase exactly what that looks like and what that visualizes